Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading reports for January 26, 2013. We have a market that is bullish quiet. It's at 67 out of 100 on the annual weekly RSI 14, so at the high end of neutral. At 70, that goes to overbought conditions. It's at 100 on the 10-day NDX, so well overbought. Both the 200-day moving average and the slope of the 50-day moving average went green bullish this week, so very positive readings on both of those. ADX 14, 29.4, so we have a strong uptrend with bulls in charge. ATR percentage has dropped to a very quiet 0.62%. The risk off slope value is 1.17. That's the ratio of the 30-day moving average to the 10-day moving average on the VIX. That is, since it's above 1.0, that's risk on. The z-score of that reading is 2.03, so it's 2 standard deviations above the above average of the last 5,000 days. So it's an extreme positive reading. You can see that it's been that way now for 5 days. This is the last 30 days of that reading. No change to the 26 or 13 ETF portfolio for blended monthly. They're all doing well. Next reevaluation there's on or about 1 February. ETF 2, the theoretical exposure and the model portfolio, both at 100%. This week in the model portfolio, we're upgrading the PCY and RWX ETFs to U.S. home builders and timber. I'll do that Monday morning at the open. There's a link to a 14-hour intraday trade from the chat room. Just a quick look at the ETF portfolios for blended monthly, again dominated by the internationals. U.S. mid-caps actually doing pretty well, moved into the top 3 here. Market health check. Everything is positive. The vertical blue lines are 10, 20, and 30 days worth of look back. Thick black line in the middle is the 30-day regression line. The outer black lines are the channel formed by the maximum excursion from the regression line during the look back period. The slope of the 30-day is up and getting stronger. It's the strongest it's been in the last 4 months. You can see price is in the blue shaded area. That's the what we're calling the river's floodplain. That's between 1 and 2 standard deviations above the mean. The river is sloping up. The river and its floodplain are completely above the 200-day moving average region. So that's good. You can see the thick red lines indicating support levels in the past. And we're well above the previous swing highs, so there's no resistance overhead. All systems go. It's overbought and been overbought for a while. The jaws of PPO are open to the upside, so that's everything is positive here. First level of support is at 146. That's what a bull market looks like. Summary of the indexes from ETF 2, all on a buy signal based on their price relative to their 4-month moving average. The globals are stronger than the U.S. right now. EFA is better than SPY. Inside the U.S., mid caps, small caps, large caps, then tech. And the 2 strongest ETFs, 2 strongest regions are Europe and Asia less Japan. The 2 weakest are the Qs and Latin America. Market health check of the world market model. You can see the U.S. is above average for mids and smalls, below average for the large caps. All of the alternate asset classes are lagging. Asia and Asia less Japan are above average. Weakness in Malaysia, Singapore, Taiwan, South Korea, everything else is above average. Anything Europe is strong. The U.S. Business sectors are lagging behind their international counterparts with the exception of energy. Top 30 ETFs based on the ETF2 large database, dominated by the internationals, although U.S. home builders have snuck in there. Little change from last week. Anything Europe is strong. The Dow 30 sorted by relative strength. Bank of America, Cisco, JP Morgan, United Tech, and Home Depot remain the top 5. Bank of America just dominating. You can see how high Hewlett Packard has climbed from off the bottom. It used to be the worst in the deck, and now it's up in the top 10. And again, you can see its relative strength changes to the positive first. The average score, the consistency score, and the 40-week quality score are lagging. The losers then, we're interested from a value play. Intel, Walmart, Merck, Verizon, AT&T. Coke and Microsoft have moved off the bottom and are starting to move their way up. ETF liquidity, just for reference. Okay, we're going to shift now to the daily report. Won't repeat the top row. Looking at overreaction and channeling, no signals here. You can see the risk Z here and the time series of the actual slope of the ratio between the 30 and the 10-day moving average of the VIX. See how it's above above the line here, and that's positive. You see how much volatility has really come out of the market. It's at a 6-month low, and ADX has done nothing but get stronger with bulls in charge. 30 is beginning to be the upper limits of a very strong move now. It's hard for SPY to get above 35 and hold. So this is we are in a well-formed strong bull right now, strongly trending. 10-day max pains: Intel, American Express, Hewlett Packard, Bank of America, or excuse me, Boeing, and Verizon. Among the ETFs, it's the VIX, gold miners, South Korea, Malaysia, and silver. Coal, KOL, is on a channeling setup. Emerging markets on a 5-day down. The NASDAQ, the Q's on a 551W. That looks attractive to me. Inside the auto framer, you can see the symbols of those that are based on trade location have a 2-to-1 reward to risk ratio. Very few patterns here, a handful of dojis. This is the triple screen inside Bank of America. The top 5 max pain range compressions. Intel offering a 6.5 to 1 reward to risk ratio. American Express 3.6 to 1, and Boeing at 2.1 to 1. IBM, just based on trade location, has no patterns, but is offering 2.9. Among the ETFs, again, handful of dojis, a channeling in coal, 5-day down in emerging markets, and it also has a 5 on the RSI2 value. Gold offering 4 to 1 on reward to risk on the auto framer. And then the VIX and Treasuries both are 1 and 2 on the max pain range compressions and offering good reward to risk ratios as well. Hard to improve the regression line here. That's pretty powerful. And we're now more than one standard deviation above the 6-month average in the slope of the regression line. It's taken out that resistance here. The slope of the regression line above its 10-period moving average. You can see the percent stretch has moved 1, 2, 3, 3.5 standard deviations off the last time it touched underneath the 200. So that's been quite a move. Z-scores of swing gains. This is a relatively new report. All of these that are now shading into the green on the 20 and 40-day holding, what that means is this swing move of the last 20 and 40 days is exceptional for each one of them. And so the only concern I have there is, number one, make sure that I'm taking advantage of that upward buying pressure. Number two, be mindful that the biggest falls come from the greatest heights, and I'm going to be concerned about ensuring that I preserve profits while I'm participating in the gain. So the extreme conditions lead to extreme moves. You can see just how horrible the VIX has been. Weakness in Cliff's Natural Resources and Caterpillar and technology on these 5 and 10 day periods. Those are the ones that are lagging. You can see the weakness in technology compared to all of the other indices. Doesn't get much better than this on the regression line slopes for the 10, 30, and the 90. You can see both the 10 and the 30 are above the 1.0 channel, and now the 90 has crossed over its zero line and is facing up. See prices well outside the river and going up, and the jaws of the river getting wider. So that's all positive. Again, leaving it has crashed through the last line of resistance, and there's full speed ahead. Small caps you can see in a much better position than large caps. Gold is at a support level, as are treasuries, and so we'll see if there's real legs in here. Then I'd expect a breakdown in gold and treasuries. Just reference data, the usual reference data from the daily. I'll let you look at those at your leisure. This is a new one I've added for at member request on looking at the Dow Transportation Index Quality Report. And this takes the 20 symbols that are in the Dow Transports and then applies the system quality number look at them. The default sort is 31 to 260, so it looks at the last 12 months minus the last 30 days. The last 30 days are quality scores noted in here. There's often a divergence in those, as you'll see. Kirby Corporation has been among the worst of the last 12 months, but in the past 30 days has had an exceptional move up. And you'll see even the worst one, Norfolk Southern, is above average with a 3.79. So that's not a bad way to think about bottom feeding, is to find the ones that are horrible and then start looking for them to make 30-day rebounds off the bottom. And conversely, you'll notice the ones that were excellent in the last 12 months have been below average the last 30 days. Although the quality number score is pretty good for them, what you may not realize is that, they're actually lagging behind things like Landstar. So this could be one that is emerging into strength on the basis of being below average by every long-term measure, and then really being on fire the last 30 days. So that you could look for maybe some momentum plays there. The same with Kirby Corporation. Delta might be one that is easier for you to stomach because it's been above average for the whole past year and then is really starting to move in the last 30 days. So that one might be easier to look at. Pivots and safe zone correlations. So that's the review of the weekend report. It's a bull market, all systems go. Global's in charge, the selected areas in the U.S. catching up. A 551W in technology is attractive as an idea. It may be time for it to resume. We'll see what happens with Apple, which had a 10% sell-off this week on negative earnings. Is its day done, or has it gotten into a value position? So, Ken Long from Tortoise Capital. Keep your powder dry, and thanks for your kind attention.